The stock market is a place full of opportunity, with potential to make some serious money, and it seems everyone wants to get involved in one way or the other. Some people just want to put their money into index funds or individual stocks and hold it long term, making their 7 to 10% every year, which is a great option for passive wealth building. But there are others who are trying to maximize their stock market gains through shorter term buying and selling, trying to take advantage of the price change a stock makes over the course of a month, a week, a day, or even just a few minutes. In this video, my goal is to help you get started learning the basics of trading stocks in the stock market in a very easy to understand way. A lot of times it can be very overwhelming when you're trying to understand and learn something new, and a beginner's guide like this one can be very helpful. So starting off at the beginning, what is a stock? In simplest terms, a stock is just any company that sells off a percentage of its company to the public through the use of shares. And shares represent partial ownership in the stock or company. So if you were to buy one share of a company, you'd be buying a piece or part ownership of the company, albeit a very, very small portion. Shares of a stock can be traded on a stock exchange, with the most popular one being the New York Stock Exchange, or for short, NYSE. You make money from stocks by what their share value is worth, which is the price of a stock. So one common practice is buying shares of a stock and selling it for a higher price over a short period of time, almost like flipping in this practice known as stock trading. Now we need to talk about the most important part of trading a stock, and that is without a doubt price, because without price, there is no stock or money to be made from it. The price of a stock is determined by its market capitalization, or market cap, divided by the amount of shares the company offers. Market cap is simply what the company is valued at or worth. For example, Apple is one of the most popular stocks in the stock market, and at the time of this video, Apple's market cap is around $2.5 to $3 trillion. If you divide that number by the number of shares they offer, you'd get roughly the stock price for Apple, which is sitting around $150 to $200 per share. Now, the old trading mantra is to buy low and sell high, but the problem with this statement is we don't necessarily know what low for a stock is, or when it's undervalued, and we certainly don't know when it's too high and overpriced. Well, there are actually two strategies to find out if a stock is a good deal. You can do it through fundamental analysis or technical analysis. Fundamental analysis at its core is going through the fundamentals of a company's financials, their business model, and taking into account economic factors. You care about what the company offers, the success of the company, and if you think the company has a future down the road. Then if you think that based on these factors, the company should be worth more or will be worth more in the future, you invest in it. If done properly, this is one of, if not the best way to try and determine the long-term success of a company. The problem with this is that stocks can be irrational in the short term, and the price can act on hype or factors that don't directly correlate to a stock's success. Take GameStop, for example. GameStop is a failing company that has not been very profitable in many years, yet, in January of 2021, their stock price soared on hype, which brings me to the other way of determining whether a stock is a good deal, and that is through technical analysis. If you use fundamental analysis to invest in a stock and hold it long term, you could use technical analysis to trade a stock in the shorter term. Technical analysis is observing and identifying trading opportunities through analyzing statistical trends and patterns. In essence, you are looking at past price action to predict future price movement. If a stock has a pattern of doing something, it has a higher chance of doing it again. You are not worried about how much the company made last quarter or what product they sell, you are most concerned with price. For example, I've noticed that whenever X happens, a lot of times Y will be the result. In trading, the price of a stock is shown through something known as candlesticks, and they are put up on a candlestick chart to represent the price action or movement of a stock. Candlesticks represent the supply and demand of a stock during whatever time period it is set at. In this chart, you can see that each candlestick represents 1 minute of price action, and in this chart, each candlestick represents 1 day. Candlesticks show supply and demand, and supply and demand is determined through human emotion. Technical analysis is essentially trading off of human emotions by figuring out what the general public believes a stock is worth during that time period. So how do you read a candlestick? Well, each candlestick opens at one of the two sides of the body, or the thick part of the candlestick, depending on the color. With a green candlestick, the candlestick opened or started at the bottom of the body section right here. This means the bar opened at the bottom of the body and closed at the top of the body. Since the candlestick is green, that means the close was higher than the open, meaning the price went up. With a red candlestick, the candlestick opened at the top of the body section right here and closed at the bottom of the body section right here. Since the candlestick is red, that means the open was higher than the close, meaning the price went down. The lines coming off of each end of a candlestick are what's known as wicks. The bottom and top wicks represent the range of the candlestick. So the top wick is the highest the price went before the candlestick closed, and the bottom wick is the lowest the price went before the candlestick closed. The wick on the bottom of a candlestick is also known as a bottoming tail, and the wick at the top is known as a topping tail. We can use these candlesticks with their wicks to determine the thought process or emotions behind the stock price. This is how a candlestick moves in real time. In this example, the candlestick opens at $10 and then goes down to $9. This creates a red candlestick with no wicks because the body is at the low end of the range at $9 and the open is at the high end of the range at $10. Now if the candlestick moves up to $9.50, the body of the candlestick that was at $9 now becomes a wick at the bottom because that is the lowest the price has gone during this candlestick. But now if the price goes up to $11, the candlestick is now green because the price has gone above where the open was at $10. If the price goes down to $10.50, then the body of the candlestick that was at $11 now becomes a wick at the top, because that is the highest the price has gone during this candlestick. If the candlestick closes, then the moving part of the body stops and a new candlestick opens. This is an example of how a candlestick might form in real time. So here's an example with a real candlestick chart. If we take a look at the candlestick right here, we can see that the candlestick opened, went down to the bottom of the bottom wick, and then the general consensus was that it was underpriced and a good deal. So the buyers then bought the stock back up and it closed higher. This candlestick at one point was red, and the wick used to be where the body was. Now since this is a 1-minute candlestick chart, each candlestick represents 1 minute of price movement. So for example, when this candlestick closed, this candlestick opened. The price of this stock during this candlestick opened at $45.41. Then it turned into a green candlestick going up to $45.45, with this wick being part of the body. Then it went down, making what used to be the body of the candlestick a wick. When it went down, it went below where it opened at $45.41 down to $45.38. So it turned into a red candlestick with this wick being part of the body. Then it went up a little, making this part become a wick before eventually closing right here at $45.39. So $45.45 was the highest the price went before the candlestick closed, and $45.38 was the lowest the price went before the candlestick closed. The thing is, we don't know, looking at it in this state, which order it moved in. It could have gone down to the bottom wick first, then moved up to the top wick, or it could have moved up to the top wick first. We wouldn't know unless we were watching it as it formed. And that is the basics of how a candlestick works. So by observing the past price of a stock and the current price of a stock, it can help us determine what the future price of a stock will be. The best way to do this is through the simplest form of technical analysis, which is with support and resistance. Support is essentially a price area where buyers have stepped up in the past and have a higher chance of stepping up in the future. Resistance is the reverse of that. It's where sellers have sold previously and is most likely where they will do it again. Support can be used to figure out when a stock will stop going lower, turn around, and go higher. And resistance can be used to find the best time to exit a position before it changes direction and goes lower. Now if we look at this stock, AA, we can see a clear area of support at the $45.50 price level. Buyers have come in and bought the stock up whenever it's gone to that area. This means that whenever the price of AA goes to $45.50, it has a good chance of being bought up again, seeing how in the past, the general consensus was that the stock was undervalued and a good deal whenever it got down to that area. Also, we can see a clear area of resistance where people think AA is overvalued and too expensive at the $52 price level. Whenever it reaches the $52 price level, sellers come in and sell, bringing the stock price down. Support and resistance can be used to increase the chances of predicting when a stock will change direction, but it does not have to work every time, as seen here, where AA was getting sold into whenever it reached $52, but this time it did not and went past resistance. A support or resistance level does not have to work every time. What it does is help with having better odds that a stock will change direction, and the more times a support or resistance level is tested, the more the area has proven itself, which in turn makes the support or resistance stronger. When a resistance line is tested and the price breaks through the resistance going higher, the resistance level is now the new support. It was an area of interest before and was an area where a change in price direction has occurred in the past. The same goes for support. If a support level is broken and goes lower, then the old support becomes the new resistance. Stock traders use the phrase, the ceiling becomes the new floor, or the floor becomes the new ceiling to help understand this concept. The thing is, how do we know how many people are buying at support or resistance? We can figure that out through volume. The second most important thing behind price is volume. If we use the price of a stock to help us find the answer of when buyers will step up and drive the price of a stock up, then volume is used to help determine how much they are or will be stepping up. Each candlestick has volume, which is the amount of shares that were traded during the time frame of the candlestick. This can be helpful to determine what areas had a lot of interest and what areas didn't. If a 5-minute candlestick ends green and the volume is, for example, 100,000 shares, that means 100,000 shares were traded during those 5 minutes, and a majority of the volume was sellers selling to buyers who were willing to pay a higher price for the stock, which in turn brought the share price up during that time because demand for the stock went up. Now, if the 5-minute candlestick was red, that means that the buyers were not willing to pay at the current share price, which meant that if sellers wanted to sell, they would have to sell at a lower price, thus bringing the share price down for those 5 minutes. More volume means more shares being traded, which means it will be easier to buy and sell shares if there are more buyers and sellers. This is known as the liquidity of a stock. If a stock is highly liquid, that means the stock has a lot of trading volume, which means that order executions, or trading shares, will be easier. When a stock doesn't have a lot of liquidity or volume, it makes it harder to transfer shares because there's less interest in the stock and there's nobody buying or selling the stock. You can't buy shares if there are no sellers, which is what happens with stocks that don't have a lot of liquidity or trading volume. Trading volume is very important to understand because it can help you find out how interested the general public is in a particular stock. The nice thing about trading the stock market is there are multiple ways to do it. There are different strategies and the 3 different trading styles. We won't get into the different strategies in this video, but the 3 trading styles are day trading, swing trading, and position trading. Day trading, or intraday trading, is where you buy and sell stocks during the same day. Swing trading is where you buy stocks one day and then sell them over a day later, typically between 2 days and 1 month. Position trading is long-term trading, buying and then selling stocks anywhere between multiple months to a couple years. Each trading style is good in their own ways and all of them have their pros and cons. I won't be going into depth on these trading styles in this video, but let me know in the comments section if you guys are interested in a video explaining these trading styles. The topics that I've discussed in this video are the most basic fundamental parts of trading the stock market. Hopefully, after watching this video, you can look at a stock chart and get a better feel of what it means. There's a lot more to trading than what I've explained in this video, but you need to understand these beginner concepts that I've talked about in this video if you want to become a stock trader. With that said, that wraps up the video. If you liked this video, or this video was helpful, I'd appreciate it if you hit the like button, and if you want to see more content like this, feel free to subscribe. Thanks for watching, and I'll see you next video.